Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq, coming to you live from Exchange in Miami. And joining me for this segment, we have Bob Elliott, CEO and CIO of Unlimited, to discuss democratizing hedge fund investing. Bob, it's great to have you with us. Welcome to TradeTalks.
Thanks so much for having me.
Hedge funds, of course, are an important portfolio diversifier, but they're also costly and they're not the most accessible to too many investors. Tell us at Unlimited what you're doing and what types of solutions you're providing.
You know, instead of trying to invest directly in hedge funds and pay those exorbitant 2 and 20 style fees, what we've done is taken our decades of experience actually running hedge fund money and modern machine learning techniques, put those two things together to actually build replications of how hedge fund managers are positioned in close to real time. And we can take that understanding from that technology and basically translate that into long and short positions in liquid securities and make hedge fund style returns available for every investor at a much lower cost.
So essentially you're taking a hedge fund and replicating it within the ETF wrapper. Does that change the liquidity profile? Because with hedge funds, it's not like you can just hit the sell button and your assets are available. Does this change the liquidity profile?
Well, I think there's a lot of different advantages. Right. The first, of course, is the tax efficiency of the ETF wrapper relative to traditional LP style structures where you're typically taxed at your marginal income tax rate. You also have the liquidity, which, intraday liquidity instead of long-term lockups. In some cases in multi-manager funds, it can be 5 years that your money's locked up. And then, of course, an important component is the transparency. You know what you're getting. It's not opaque. You understand what your manager's doing. And those types of risks that exist traditionally with hedge funds related to fraud and the diligence necessary to protect that, when you're in a 40 Act product, you're in a much better structure for the investor to make sure that those things don't exist.
What type of portfolio or what type of investor would these hedge fund ETFs be appropriate for?
Well, I think for most investors, they're starting with a 60-40 portfolio, maybe a couple of low-cost index ETFs that are able to achieve that goal, and then they're looking for something to help diversify from that traditional 60-40. And so particularly those advisors that maybe have ETF model portfolios that are looking for something that's a little more innovative, a little, to sort of fill that alts bucket, but without taking on the risk of trying to pick a single manager.
This might sound like an elementary question, but if hedge funds don't have that kind of liquidity, how are you able to make the underlying assets liquid within the ETF wrapper?
That's right. Well, what they trade is very liquid. They trade, the 3,000 hedge funds that are out there are trading basically the 60 or 70 biggest, most liquid markets in aggregate. That's what they're really exposed to. And so the returns you can see relatively close to real time. And the positions that they're holding are in those liquid securities. And so we're just using our technology to match those two things, understanding the returns, understanding what's driving them, and translating that into the liquid securities positions.
Any trends that you can discern from Exchange in 2024 that really resonates, or trends that you see for 2024?
Well, I think it's really about the continued push into the alternative structure, whether it's in the crypto space or whether it's in more actively managed ETFs. Remember, actively managed ETFs only represent a few percent of the overall 40 Act products that are actively managed, a few $100 billion in actively managed ETFs relative to 10 trillion in actively managed mutual funds. There is a universe of managers that are seeing the ETF structure as a better tool for active management for the investor, particularly because of the tax efficiencies. And so we're seeing that push carrying on in the alt space.
It's surprising to me that the percent is that low, but the good thing is there's obviously room for growth. They're considering, the composure of the market has changed, liquidity profile of the market has changed. Investors want more thematics. They're also thinking about fixed income in different ways. I'm kind of surprised the percent is that low.
Well, I think there's a lot of legacy mutual funds that are out there that are getting challenged by this better structure in terms of the ETF structure, and it's just taking time to come in. And most of the people who are issuing actively managed ETFs, a lot of them are coming from the fund side and seeing the real advantages of the ETF structure, both in terms of broadening the exposures, the types of clients that can come into the product, as well as all the operational efficiencies. So they're leapfrogging what is a traditional dying mutual fund business. And so we just need to keep that trend going. Increasingly active managers will be looking for more 40 Act style products.
All right, Bob, appreciate the insight. Thanks for joining us on Trade Talks. And thanks for joining me from Exchange. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.